All right, so let us continue reading the additional information. There are still some workings to do. We are still under the non-current asset. Afterwards, under investment property, we are told that on 31st December 2015, a qualified surveyor valued the investment property at 13.5 million. Zillow Limited uses the fair value model in IAS 40 investment property to value its investment property. So we just need to find the loss on the valuation. So that will be working number 6. Yes, I'm sure. Working number 6 will be for investment property. So loss on valuation of investment property. So that will be, we had that, according to the trial balance, the investment property figure, let me put 3 zeros here. So it was 16,000. And then it's being revalued to 13.5 million. So 13,500. So that is going to give us a loss of 2,500. So that is the meaning. So we are just going to show this in the statement of profits or loss as a loss from investment property. That is all. And then when we get to the statement of financial position, after we have showed the PPE of 87,100, we show investment property's new fair value of 13,500. So that is it for that. Then we move on to the next additional information, which is the third one on interest. We are told that interest expense include overdraft charges, the full year's preference dividend, and an ordinary dividend of 4 pesos per share. That was paid in 2015, June 2015. Now we are told that the interest from the trial balance is 5,000, okay? And we need to take out the ordinary share dividend because ordinary dividend cannot be part of interest expense. That is basically what they want you to know. So we are going to subtract the ordinary dividend. But the ordinary dividend has not been given to us straightforward. We have been giving it as 4 pesos per share. And then the total number of shares has also not been given in the question. So we need to now calculate the total number of shares before we apply and multiply the 4 pesos per share by the total number of shares in order to get the ordinary dividend. And when we have the ordinary dividend, we subtract it from the interest figure of 5,000 so that we get the final interest figure to be used in the statement of profit or loss. So this is what we have to go through. Okay? And so let us calculate, first of all, the total number of shares before we can find the ordinary share dividend. Now, how do we get the total ordinary shares? Let us look at the trial balance. You see that we have ordinary shares of 25 pesos each at a total amount of 20,000. So we have a total of 20,000 Ghana cedis for ordinary shares, or 20 million. And then it is being sold at 25 pesos per share. So if you want to get the total number of shares, you divide the total amount by the price per share. And so working 7 is going to be total number of ordinary shares. And that is going to be 20,000 divided by 25 pesos, which is 0.25 Ghana cedis. And that is going to give us 80,000 shares. Remember that 3 zeros are up. Okay, so we have a total of 80,000 shares. So now that we have a total of 80,000 shares, we are told that the dividend was paid at 4 pesos per share. So dividend, ordinary dividend, is going to be calculated as 4 pesos. So 4 pesos is 0.04 Ghana cedis times the total number of shares, 80,000 shares. And that is going to give us 3,200 Ghana cedis. So ladies and gentlemen, the dividend component of the interest expense is ascertained to be 3,200, whereas we have the interest to be 5,000. We are told that it includes overdraft interest, it also includes preference share dividend and ordinary share dividend. So we want to exclude the ordinary share dividend so that we have a net interest to present in the statement of profit or loss. And so that will take us to working 8. I'll call it interest expense. So showing 3 zeros up here with the currency sign. So per trial balance, the interest expense in the trial balance is 5,000. Then we take out ordinary dividend. So ordinary dividend of 3,200 from working 7. When we take out the ordinary dividend, we have a final interest expense of 1,800, which is allowed to be taken to the statement of profit or loss. So look at what you have to go through just to ascertain this figure. It's very, very cumbersome. So you need to understand your basic principles and you need to know your adjustments very well before you'll be able to do that. So now that we have the interest expense, we are done with that additional information. Let us move on to the last but one, which is the tax. Of course, after the tax is the joint arrangement, but we've done almost everything that we need to do on the joint arrangement. So the final headache will be the taxation. So the next additional information says that the directors have estimated the provision for income tax for the year ended 31st December 2015 at 8 million. So 8 million in this case, if you put 3 zeros up, is 8,000. Then we are also told that the deferred tax provision, so the 8 million is the current tax, okay? So the deferred tax provision at 31st December 2015 is adjusted through the profit or loss statement to reflect that the tax base of the company's net asset is 12 million less than their carrying amount. The rate of tax is 30%. Now, remember that I have taught you in IAS 12 that the tax expense to be recognized is your current tax plus your movement in deferred tax. We are fortunate that in this current tax of 8 million was not affected by any prior year adjustment of current tax, because in the trial balance, we don't have any current tax in there. So the 8 million is our net current tax. Then we need to look at the movement. Now, the movement in deferred tax is just like how we treat provision or allowance for receivables. We compare and take the difference. There is an opening balance for deferred tax in the trial balance, which is 5,600. As you can see, deferred tax on the trial balance is 5,600. And so we need to get the closing balance for deferred tax, which we are going to calculate. We were not given the closing balance outright, but we've been given a temporary difference of 12 million or 12,000, which we are going to apply the tax rate that we have been given, 30% on that. And so working 9 will be on taxation. And we need to first of all calculate our year-end deferred tax. So deferred tax provision at 31st December 2015 will be, we are giving 30%, and the temporary difference is 12 million. So 3 zeros up. So 30% of 12 million is going to give us 3,600. So now that we have this becomes a closing. Remember that I told you that when we were doing the analysis, I said that, look at the question again. We are told that the net asset exceeded the tax base by 12 million, meaning that this temporary difference will result in a deferred tax liability. If the tax base was more than the net asset, then these 12 million and these 3.6 would have been a deferred tax asset. But fortunately, this is a liability. And the one we have on the trial balance, the 5,600, the 5,200 is also shown on the credit side, meaning it is also a deferred tax liability. So we need to look at the movement in liability. And we can see that if we have 5,200 at the opening balance and we have a closing deferred tax provision of 3,600, then it is a decrease in liability. And the decrease is negative. That must be adjusted on the current tax. Remember what I told you, that your tax expense to be recognized for the year is your current tax plus movement in deferred tax. Never forget this formula. Never forget this. That the tax expense you are going to recognize is your current tax plus your movement in deferred tax. So we need to find the movement, okay? And so tax expense is going to be your current tax. The current tax, let me show 3 zeros up. The current tax is 8 million. Then movement in deferred tax. How do we get the movement in deferred tax? It is your 5,200, which is the opening balance, minus the closing balance of 3,600. And because it is a decrease, it will be negative. So the difference is 1,600. So when we subtract 1,600 from 8,000, we have 6,400. So ladies and gentlemen, when we are preparing our statement of profit or loss, the tax expense we are going to recognize will be 6,400, which is your current tax plus the movement in deferred tax. So this is how to go about these workings. Okay. Then the final additional information is what we are going to look at, which is the joint operation, which we have done most of the work in there. So on 1st January 2015, Zillow Limited entered into a joint arrangement with two other entities. Each venture contributes their own assets and is responsible for their own expenses, including depreciation on assets of the joint arrangement. Zillow Limited is entitled to 40% of the joint venture's total turnover. The joint arrangement is not a separate entity. It is regarded as a joint operation. Details of Zillow Limited joint venture transactions are follows. So we have plant and equipment at cost, 12,000. We have already used that in the PPE. Share of joint ventures turnover, 8,000. We have already used that. Then share of joint ventures cost of sales, we have already used that. We are left with the trade receivables and trade payables, which we are going to use. And we are going to show that in the statement of financial position. So remember that when we get there, we have trade receivables to add and we have trade payables to add. Apart from that, there is nothing more, and then we have the requirements. So ladies and gentlemen, the workings are completed. So we can now go on to the main requirement to prepare statement of profit or loss and to prepare the statement of financial position. But remember that we should prepare changes in equity. But in this question, it looks like the only item of equity that actually changed is the income surplus. So we can prepare an income surplus account only to represent that. Or we can decide to prepare changes in equity, in which case we only show changes for income surplus. Okay. Okay, so we are going to begin the preparation. We are told to prepare a statement of profit or loss for the year ended. So there is no other comprehensive income attached. So we are going to prepare a statement of profit or loss. So for Zillow Limited, statement of profit or loss for the year ended 31st December 2015. So I'll show my currency sign with 3 zeros. And then I'll indicate the notes to the financial statement. So we'll begin with your revenue or your turnover. So turnover. Turnover or the revenue. We did working on that. So that is from note 5 or working 5. And the figure is 221,800. And then we take out the cost of sales. Cost of sales is from working 2. So note 2. So the total cost of sales was 156,200. We put that in bracket. So that gives us a gross profit of, we take this out, 65,600. So now that we have arrived at the gross profit, we move on to other income. Now, the only other income we have in this question is the rental income from investment property. Okay, so rental income from investment property. That is directly in the trial balance as 1,200. And then I told you that we are not going to create any portion for other comprehensive income. So the loss on the revaluation should come here. So loss on revaluation of investment property. That was from working 6. And then we had that to be 2,500. So we put it in brackets because it's a loss. And then there was operating expenses. So in this question, they did well by summing up both selling and general expenses for us. And then they called it operating expense. And it is given directly in the trial balance. So there was no workings also affecting that. Because even depreciation was taken to cost of sales. And so from the trial balance, operating expenses was 22,400. That also should be in brackets because we are subtracting. And so it is your other income minus your operating expenses minus the loss on the revaluation of the property. That gives us the net profit before interest and tax. So we are going to have 41,900, and that is your operating profit or your net profit before interest and tax. So once we do the workings, the work flows in a very speedy way. So we move on. So right after net profit before your interest and tax, you take out the interest expense. Remember that there was workings on this interest expense. The final figure we had was 1,800 after taking out the ordinary share dividend. And that was done at working 7. So working 7 was for the interest expense. We put that in brackets. Or working 8. Yes, I think so. So interest expense was done from working 8. So when we take out the interest expense, we have 40,100. That becomes your net profit before tax. And then we can take out our tax expense. The tax expense was done at working 9. And that was arrived at 6,400. That is the current tax minus the movement in deferred tax. So when you show note 9, then you can put 6,400 as your tax. So when we take out tax, we have 33,700. We can do a double underline and call it net profits after tax. So ladies and gentlemen, because we did not create any space for other comprehensive income, we are getting the final profit. If there was the loss on the revaluation would have moved down, okay, and so things would have been different. So like I told you, when you go to the exam hall, there will be a requirement. So whatever requirement they give you is what you are doing. If the question says you are required to prepare statements of profit or loss, please, no comprehensive income. If the question says you are required to prepare statements of profit or loss and other comprehensive income, then you create that and then move that downwards. So that is a dynamic that you should understand. Having understood this, we move on to prepare the statement of financial position. But we are told, yes, that is the next requirement. But we know that we need to do changes in equity. In this question, we are not required to prepare changes in equity. And so we can adjust for it on our own. We need to actually do that. But the stated capital did not change. There was only one revaluation surplus at the beginning. Nothing was added. There was no general reserve or any other reserve. So the only thing that actually changed is the income surplus. So instead of preparing the whole statement of changes in equity, you can prepare changes for only the income surplus, which is also acceptable. So instead of preparing changes in equity, knowing very well it is the income surplus that is changing, you can prepare an income surplus account. So you say income surplus account for the year ended 31st December 15. And then you show your currency sign with 3 zeros. You start with your opening balance. So from the question, the opening balance for income surplus, as you can see on the trial balance, is 17,500. So we show that 17,500. And then we add the net profit after tax, which we all know. So we add the net profit after tax. And the net profit after tax is 33,700. So we add that. And that is going to give us 51,200. Now, the only thing that is going to affect the income surplus balance is the dividend payment. The dividend that we took out from the interest will now be subtracted from the income surplus. So we less ordinary share dividend. And from the workings that we did, I think that is from working 8. We had ordinary share dividend to be 3,200. So that is going to give us the final figure for the income surplus, which is going to be 48,000. So the balance carried down on the income surplus account is 48,000. So ladies and gentlemen, instead of preparing a whole statement of changes in equity, we were not required for that. So we can use the income surplus account to reflect only the changes in the income surplus. Stated capital didn't change. Revaluation surplus didn't change. So we can pick those figures directly into the statement of financial position. So this is how to go by the statement or the income surplus account as well. So having understood this, we are now moving on to the final requirement, which is to prepare the statement of financial position. Okay. So let's prepare statement of financial position as at 31st December 2015. So I'll show my currency sign with 3 zeros, and I'll show the notes column as well for workings. And then I'm going to begin with the non-current assets, as you know. Under the non-current assets, this question we have only two. We have the property, plant, and equipment, and we have investment property. And remember, we have already done the property, plant, and equipment schedule as working 3. So we write property, plant, and equipment. So instead of bringing in each asset individually, we bring the final figure. That is note 3. And when we did the PPE schedule, the final figure we had down there on the right was 87,100. So that is the figure we are bringing, 87,100. And then there's investment property. That also was adjusted through profit or loss. That is for working 5. So investment property is 13,500. That is the new fair value. Okay, so when we combine the investment property, there were no intangible non-current assets anyway. So when we combine the two, it gives us the total non-current assets. And that is 100,600. So we are done with the non-current assets. So we leave a space on that line. We move to the next line, and then we write our current assets. Current assets. Now, let us bear in mind that there are joint venture transactions that need to be adjusted on the trade receivables and payables. So please take note. And the inventory adjustments that we did must have 2 treatments. The first one is that it's increasing cost of sales, which we did. The 300 difference on the inventory adjustment. The second is that it's also going to reduce the inventory, the value of the inventory. So the value of closing inventory on the trial balance, as you can see, is 10,500 or 10.5 million. So that 10,500, we begin with inventory into bracket 10,500 minus 300. The 300 is the adjustment on the inventory that we did. So that is going to give us a net inventory figure of 10,200. And then we move on to trade receivables. Now, if you look at the trial balance, the trade receivables figure we have over there is 13,500. But it is also going to be added to the joint operations. Now, in the joint operations, trade receivables is 1,500. So we are going to have total trade receivables of 13,500 plus 1,500. And that is going to give us 15,000 for the trade receivables. Remember, we are adding up everything from the joint operations. And I think in this question, the cash at bank was an overdraft. So that will go under current liabilities. There are no other cash and cash equivalents. There are no other receivables. And so that is all for the current assets. So total current assets will be 25,200. So when we add the two, we have total assets of 125,800. So that is your total assets figure, 125,800. So we can look at our equity and liabilities. And then we are going to begin with equity. Now, the items of equity, we have the ordinary share or stated capital, which did not change. According to the question, the ordinary share capital is 20,000. There were no changes. That is why we did not prepare the changes in equity. And then also there was the income surplus, but the income surplus actually changed. So with the income surplus, we are going to pick the final balance of 48,000 and present it here. So 48,000. Finally, there was a revaluation surplus from the revaluation of the land and building. So revaluation surplus. That was at the beginning and it did not change and it is 21,000. Please, this is shown on the trial balance. So as you can see, there is a revaluation surplus of 21,000 on the trial balance. So when we add these three, it gives us the total equity to be 89,000. Now that we have the total equity to be 89,000, then we look for the long-term liabilities or the non-current liabilities. So long-term liabilities. Now, if you go through the trial balance, we have 10% redeemable preference shares. We have redeemable preference shares of 10,000 Ghana cedi. That is a liability. So 10% redeemable preference shares, 10,000 Ghana cedi. And then remember that there was a deferred tax liability we calculated. We are going to use the closing balance, which we had, which was the 3,600, will also come as a long-term liability. So deferred tax, 3,600. So these are the only two liabilities that we have. So whilst the preference share becomes a long-term debt, the deferred tax also appears as a liability. So total non-current liability gives us 13,600. So we show that as an underline. And when we are done, the final thing is about the current liabilities. We leave a space and we write current liabilities. And then we can underline that as well. Now, under current liabilities, in the trial balance, we have trade payables. But remember that the trade payables will be affected also by the joint venture. So the trade payables in the trial balance is 11,800. And in the joint venture, the trade payables figure in the joint venture is 2,500. So 11,800 plus 2,500 gives us 14,300. And then there was a bank overdraft. So bank. The bank overdraft is 900 in the trial balance. And then I think, yes, and there is one more thing you may have, if you are not careful, you forget. The current tax for the year of 8 million. You see that when the tax expense to be recognized was estimated at as your current tax plus movement in deferred tax. So the movement in deferred tax there, we don't care about that when it comes here. But the current tax must be a current liability. Because so far as it's in the additional information, it is not paid. So your tax liability, the tax payable will be the current tax. And that is the 8 million or the 8,000. Never forget to bring your tax liability as long as it has not been paid. Okay? So that is a tax payable. So when we add these three, total current liability becomes 23,200. So now that we have this, we need to combine our equity, our long-term debt, and then our current liabilities to get the total equity and liabilities. And ladies and gentlemen, the total equity and liabilities is 125,800, just as the total assets. And so it has balanced. Yes, so this is very simple, even though it's not too simple. But you need to follow the steps. You can rewind this video, look at it again, and try and understand the procedure. So this brings us to the end of the part 2 of our video on final accounts or financial statements for publication. We are going to solve other questions later, but for now, we are going to focus on other topic areas as well, because I've been receiving a lot of topic requests from you. So I'm going to solve and treat other topics as well. Remember to subscribe to this channel. If this is your first time, share this video and let others also have a benefit. And until we meet again for another video, it is bye for now.